So you want to own an industrial warehouse. Buy a big empty box somewhere off a highway exit. Sign a tenant. Collect rent every month. And never think about it again. That's the picture in your head. The boring landlord dream. No toilets to unclog. No guests to please. Just steel walls and a concrete slab, quietly generating income while you do literally nothing else. Here's the problem. Warehouses have become one of the hottest asset classes in commercial real estate over the last decade, specifically because everyone believes exactly that story, and the moment an entire industry believes an asset is boring and safe, that belief itself starts changing the price you have to pay to get in, and the risk you're actually taking without realizing it. An industrial warehouse is not really a real estate business. It is a bet on the shape of global supply chains wearing the disguise of a simple building, and the moment you understand that difference, everything about how a warehouse makes money and how it can quietly become a liability starts to make sense. Let's start with the price list, because just like every asset we've broken down before, industrial warehouses come in tiers, and the tier you buy into is really a different business entirely. At the bottom sits the small local flex industrial building, the kind of property leased to a single local business, a contractor's storage yard, a small manufacturer, a regional distributor, typically running anywhere from 5 to 20,000 square feet, and priced anywhere from $500,000 to a few $1,000,000 depending on the market. Above that sits the mid-size regional distribution facility, 50,000 to 200,000 square feet, the kind of building leased to a growing e-commerce brand or a regional trucking and fulfillment operation, requiring anywhere from $5 to $50 million to acquire or develop depending on location and specification. At the very top sits the mega warehouse, the kind built for a single massive tenant, a national retailer's regional distribution hub, or a major logistics company's automated fulfillment center, sometimes exceeding 1,000,000 square feet under one roof, representing hundreds of millions of dollars in construction and land cost, and requiring the kind of institutional capital that only REITs, pension funds, and large private equity firms can typically deploy. Each of these is really a different bet on the same underlying question. Are you leasing space to a small local business that could vanish in a bad year, or are you locked into a long-term relationship with a massive corporate tenant whose own fortunes now directly determine yours? Now here's where the naive mental model falls apart immediately. You assume the value of a warehouse comes from the building itself, the steel frame, the loading docks, the roof. It doesn't. Not primarily. The genuinely dominant factor in industrial real estate value is location relative to population density and transportation infrastructure, and this has become dramatically more specific and more valuable over the last decade because of a single structural shift, the rise of e-commerce, and the resulting obsession with same-day and next-day delivery. A warehouse sitting within a tight radius of a major metro population center, close to highway interchanges, and ideally within range of an international airport or port, commands rents and valuations that can run several multiples higher than an identical building sitting an extra hour further from that same population, because the entire economics of last-mile delivery depend on how many hours a delivery van needs to drive before it even starts dropping off packages. This has created what the industry calls infill industrial demand, and it's produced some of the most dramatic land value appreciation in the entire commercial real estate sector, with older, low-density industrial land near major cities becoming so valuable purely for its proximity that some existing warehouses have been demolished entirely and rebuilt taller, multi-story warehouse structures specifically to fit more distribution capacity onto the same increasingly scarce urban-adjacent land. Here's the part almost nobody outside commercial real estate understands about how these buildings actually get built and financed. Unlike a hotel or an apartment complex where the developer takes on enormous speculative risk building first and finding tenants later, a huge share of large modern warehouse development happens on a build-to-suit basis, meaning a major tenant, a national retailer, a logistics company, a manufacturer, signs a long-term lease commitment before construction even begins, and that signed lease becomes the collateral the developer uses to secure construction financing in the first place. This dramatically de-risks the development process compared to speculative office or retail construction, but it also means the entire value of that warehouse becomes tied directly to the creditworthiness and long-term viability of a single corporate tenant, a concentration risk that doesn't exist in the same way for an apartment building with 100 separate households each paying their own individual rent. Now let's talk about what it actually costs to build or acquire one of these, because the price varies dramatically based on specification, and specification has become the entire ballgame in this industry. A basic older generation warehouse, lower ceiling clearance, fewer loading docks, no advanced climate control, still exists throughout most American industrial markets and can be acquired relatively cheaply, but increasingly struggles to attract quality tenants at competitive rents, because modern logistics operations have very specific physical requirements that older buildings simply weren't built to accommodate. Clear ceiling height has become one of the single most important specifications in the entire industry, because modern automated storage and retrieval systems, robotic picking equipment, and high-density racking all depend on vertical space, and a building with 32 or 36 feet of clear height can support dramatically more storage capacity and automation than an older building topping out at 24 feet, even on the exact same building footprint. Loading dock density matters enormously too, since a distribution facility's entire throughput, how many trucks it can load and unload per hour, is constrained directly by how many dock doors line its perimeter, and modern e-commerce fulfillment centers are increasingly built with dramatically more dock doors per square foot than older generation warehouses ever needed, because they're processing far more individual small shipments rather than fewer large bulk pallet deliveries. This is where the industry's own version of the tire factory's raw material exposure shows up, capital expenditure that never really stops. Roofing on a large industrial building represents a genuinely enormous replacement cost when it eventually fails, often running into the hundreds of thousands to millions of dollars for a large distribution center. And unlike a smaller residential roof, a warehouse roof failure can mean water damage to enormous quantities of a tenant's stored inventory, creating liability exposure far beyond the cost of the roof repair itself. HVAC and climate control have become increasingly important cost centers too, as more warehouse tenants require temperature-controlled space for pharmaceuticals, food products, or sensitive electronics, and retrofitting an older ambient warehouse with real climate control can cost millions of dollars, though it also unlocks access to a much wider and often higher-paying tenant pool once completed. So where does the actual revenue come from? And this is genuinely the simplest revenue model of almost any commercial real estate asset we've covered. Industrial warehouse leases are overwhelmingly structured as triple net leases, meaning the tenant, not the owner, pays property taxes, insurance, and maintenance directly, leaving the landlord with a remarkably clean and predictable income stream compared to a hotel with its constant operational complexity, or an apartment building with its endless stream of individual maintenance calls. This structural simplicity is exactly why pension funds and insurance companies love this asset class so deeply. They're essentially buying a long-duration, relatively low-volatility income stream backed by real physical collateral, without having to manage staff, deal with individual tenant turnover constantly, or absorb unpredictable operating cost spikes the way owners in almost every other real estate category we've discussed have to. But here's where the shadow risk in this industry becomes impossible to ignore, and it's the exact mirror image of the reason this asset class became so popular in the first place: tenant concentration and lease rollover risk. Because a single warehouse typically has one, or at most a small handful, of tenants rather than dozens or hundreds like an apartment complex, the loss of a single major tenant isn't a minor vacancy problem, it's a catastrophic income event. A 1 million square foot distribution center, leased entirely to one national retailer, generates zero revenue the moment that lease ends and isn't renewed, and finding a replacement tenant of similar scale and creditworthiness for a building of that exact size and specification can take many months or even years, all while the owner continues absorbing debt service, insurance, and property tax obligations with no offsetting rental income whatsoever. This risk has become considerably more visible in recent years, as e-commerce companies that signed enormous pandemic-era expansion leases, betting on continued explosive online shopping growth, subsequently right-sized their real estate footprints once growth normalized, leaving some landlords holding massive facilities built to one company's exact specifications, with genuinely limited alternative tenants capable of using that specific space efficiently. The case studies in this industry tend to fall into two categories worth understanding before anyone signs a purchase agreement. The first is the speculative developer who built enormous facilities during the pandemic-driven e-commerce boom, betting that explosive online shopping growth and depressed interest rates would continue indefinitely, only to face a genuinely difficult leasing environment. Once online retail growth normalized and interest rates rose sharply, leaving some developers holding partially vacant or underleased mega warehouses at exactly the moment refinancing that debt became dramatically more expensive. The second is the disciplined infill industrial investor, the kind of operator who deliberately targeted smaller, well-located buildings near dense population centers with diversified local tenant bases rather than chasing the biggest possible single-tenant mega facility. Understanding correctly that a portfolio of smaller buildings with different tenants across different industries provides genuine diversification that a single giant building leased to one company simply cannot offer, no matter how creditworthy that one tenant happens to be at the moment the lease was signed. Time to pull it all together and answer the actual question: how much money do you make if you do this right? In the realistic infill scenario, a well-located 50,000 square foot distribution facility, acquired for around $8 million, leased to a stable regional tenant on a long-term triple net lease. You can generate a genuinely reliable 6 to 8% unlevered annual return purely from rental income, with minimal ongoing operational headache compared to almost any other real estate asset class we've covered, precisely because the tenant is contractually responsible for most of the costs that eat into an apartment or hotel owner's margin every single month. In the concentrated risk scenario, a large single-tenant facility built specifically for one major corporate tenant can generate excellent returns for years while that lease remains in place, only to see its value and income collapse dramatically if that tenant doesn't renew, turning what looked like the safest, most boring asset in commercial real estate into a building that might sit partially vacant for years while carrying full debt obligations regardless. So if you do decide to buy an industrial warehouse, remember the one thing that actually determines whether you succeed. It was never really about how many square feet you own. It's about how many different tenants are actually paying you rent inside that square footage. Because in this industry, the building that looks the most boring and diversified on paper is almost always the one that survives the downturn everyone else didn't see coming.